Welcome to Stock Shotz. Today we have Generation Debt author Anya Kamenetz. Anya, thank you so much for taking time out of your schedule to be with us here on Stock Shotz.
Thanks for having me.
Anya, please tell us a little bit about your book, Generation Debt, why you wrote it, and some of the things that you're seeing going on in our economy today.
Sure. So Generation Debt, I came out in paperback in 2007, and it's a book that I wrote in response to a lot of the broader economic trends that I saw affecting younger people specifically, such as the rising cost of higher education and student loan debt, as well as the changing job market, the fact that we're taking longer to prepare for our first jobs, that the quality of the average job is declining in terms of its pay and its benefits, and then just, the various problems in the form of consumer credit that face young people that are trying to get a good start in their financial future, but they're already hobbled by debt even when they're just getting out of school.
With the current housing situation, there's been a lot of debate about whether or not the government should bail out some of the subprime borrowers. Give us your opinion on that.
Sure. Well, homeownership is an interesting case of the way that, things have changed for this generation, because I think, historically the wisdom has been that a house is the cornerstone of middle-class wealth, and it's always a good investment for a young person. However, in the last few years, the rate of home ownership has gone up a lot among youngest borrowers, but it's not the same kind of reasonable, rational decision that they're making. Rather than save up a 20% down payment and get into a 30-year loan, you've seen a lot more people borrowing the full cost of a house and borrowing far, far more than their income would allow for it. And I think that for young people who are watching this, hopefully most of them have not yet gotten into the market, that they're still on the sidelines. And I think that we're all kind of looking for the sanity of the old ways to be restored in some sense, that a home would be not so expensive, not so large relative to your income, and that you wouldn't rush into it without having the necessary savings in place.
Absolutely. One of the things that I've seen, particularly down in the South, is that a lot of people made the transition from just exactly what you just described, of having a home, living the American dream, buying a home, and they looked at it as a way to finance a speculative investment. Really didn't intend to live in it that long, but this was a way for some young people to come out and essentially do what I would do in the stock market, and that's lever up, but they did it with their home. Now, do you believe that the government should intervene and allow these people to suspend any increases on their mortgage, or what's your opinion as far as the government regulation in the housing market right now?
Well, I think when it comes to foreclosures, obviously there's a lot of pain involved for the families that may be involved in that, and I really understand the sensitivity of lawmakers and of people who consider themselves advocates that, that people shouldn't be put out on the street, particularly if, in some cases, because of the role of the mortgage lenders as well in getting people into houses that they couldn't necessarily afford. I understand that it's very difficult to separate sort of the effect of who is a speculator versus who is someone who just made a bad decision on a home loan and could actually maybe qualify for a larger loan. So, the intricacies of it are not something that I really get into. I think that, you need to be able to design any kind of package such that there is some. I believe in expanded power for the federal government to acquire certain loans when the alternative is putting a family out on the street.
Well, one of the things that I hate to see us do is start to, and I understand, I support what the Fed did with regard to bailing out Bear Stearns, not the shareholders, but to provide the liquidity so that we didn't essentially have a run on the banks. But I hate to see the government get into a situation of bailing out people. I, for one, am one of the old school ones that you described. I put my 20% down on my house. I bought a house that I could afford, and I really don't want to see my tax dollars go out and support somebody that went out and overbought. But I do understand that there is a sensitivity of not putting people out on the street. Let's transition a little bit now and talk about your book and the references that you make to education in there, because I've got some ideas that I'd like to discuss with you. But tell me what your book talks about the financing the college education, and you said that you had done some research and that the starting jobs are not what they used to be from that college education.
Right. So basically what I've been looking at is, first of all, the desire and the need for people to go to college is higher than it's ever been before. And 2008 actually was a record year in the U.S. for high school graduation, and admittance rates at some of the most prestigious colleges in the country dropped to record low levels. So you had a very large number of people competing for smaller spots. And, just simple supply and demand, you'll see that, the price of college is going to go up as a result. And sure enough, over the last couple of decades, after inflation, tuition in both private and public colleges has doubled. So you have this sort of perfect storm effect where people are trying really hard to get that four-year bachelor's degree because they really see it as the only alternative for a middle-class income. And, the fact is that if you don't get a college degree, that your income is going to suffer for about 30% compared to people of that same education level a generation ago. So, the types of manufacturing jobs and the types of, non-college jobs that previously were enough to raise a family on now just aren't available. So you really need that college degree if you're going to get, a middle-class income, obviously leaving out certain types of crafts and other types of middle-class jobs that could be achievable without a college degree. But in general, the demand is really high. The reward when you get out of college is obviously always going to be up to the individual's abilities and interests. And the thing that I always caution people to do is to say, this is a huge investment that you're making. The average cost is about $54,000 at a public university for a four-year degree. And you need to make sure that that's the right investment for you, that that these are where your interests lie, that you really are going to be prepared to do something with it, because it's a very expensive mistake to make.
Now, I'm more of a free market. I believe in letting the capital markets work. So what I've heard about the rhetoric of more one central or expanding the powers of the Federal Reserves over the investment community, I'm a little skeptical of. But one thing I think that I would support is more federal dollars going into higher education so that more of our citizens could obtain a college education at a lower degree, and then, at a lower price. But then I think we should let the free markets work past that. But I do think that we have created barriers within our own nation to getting that higher education, and I think we should afford that to all of our citizens. I've seen you write a little bit about increased federal regulation. Do you believe that we should have heightened regulation with regard to the financial markets, and if so, could you explain that for us?
Sure thing. Well, I really can't go beyond too much more than just a statement of general principles here, because I'm not an expert in the financial markets, but it does seem to me that the reason that people keep referencing the Great Depression in this case is that we are in a very precarious situation with regards to unregulated areas of financial markets, such as these financial firms that are hedge funds, private equity funds. They're operating outside the previous regulatory authority of the federal government. They don't seem to be really subject to any kind of fiduciary oversight or requirements. And, the dangers are really great when you come to the point that, this small hedge fund firm, Bear Stearns, had to be bailed out because the entire economy was at risk. And then you kind of get to the question of, are we going to wait till the last minute to do kinds of emergency bailouts like this, or are we going to expand oversight beforehand so that that banks that any firm that is that important to our markets and to our economy should be subject to regulatory oversight, I believe.
For the rest of my interview with Anya Kamenetz, go to www.stockshotzmedia.com. That's www.stockshotzmedia.com. Thank you for listening.